Traders, in today's video, I want to go over option pricing made simple because I feel like options get a bad rap because, well, traders think they have to be math wizards or understand all the Greeks out there to make money trading options, and you really don't. In fact, I want to keep it very simple and just look at volume, open interest, percentage change. That's it. So here's my layout, and I'm going to go to a customized layout on Thinkorswim. I have volume, open interest. So volume, the number of option contracts that have traded today. Open interest, number of options that have traded in the past. I like looking at this as a gauge. So let's say someone bought 5,000 January call options in Twitter yesterday. And then today, those 5,000 contracts in Twitter and open interest, I know they bought them, they stuck. It's in open interest. It's a good gauge to look at. Percentage change. This for me is very important because just as stocks move every day, percentage wise, like Apple here is up 30 cents, barely anything for Apple. Options move percentage wise every day too. And you can track the options just like you would a stock. So if you're trading an option, in my opinion, why wouldn't you track it just like you would the stock price? And then the size bid ask. This is not mandatory. The only reason I like looking at this is sometimes I'll trade stocks that do not have fantastic liquidity in the options. Like today I've been trading Dropbox, and it doesn't trade, tens of thousand contracts a day like an AMD or like an Apple or a Microsoft. Bid ask, it lets me know, what other orders are doing. Is there 50 contracts sitting on the bid trying to get bought? Or is there 75 contracts on the ask? It just lets me get a gauge, especially in a stock that doesn't trade much option volume. So not mandatory though, especially if you're trading liquid names. And here I have Apple, the weekly option chain. So January 3rd expiration. So it expires 3 days here. One thing you have to know, and this is where most traders lose money when they trade options. When you buy options, especially out the money, cheap, yeah, they go together, and then front month or short dated. This could be front month would be January, weeklies would be, this week, so January 3rd. So short dated options. These all offer fantastic risk versus reward setups, percentage-wise as a gain, but they have a high probability of expiring worthless, and they're difficult to make money trading, and I'm going to show you why. Here in Apple, again, the stock's up 33 cents. I want you to look at the in-the-money calls, the 280 calls. They're up nearly 2%. When you're trading in the money options, you have a higher delta on these options. You're basically looking at a stock replacement trade, or you're trading one-to-one with the stock. So these options are about $12. Apple is just shy of $292. It's $291.70. So they have just a little bit of premium in them, but basically these options are going to move with the stock price. Stock goes up $1, these options are probably going to go up about $1 there. You don't have to know the exact delta. Just very simple. You're basically playing a stock replacement trade. Now, look at the out-the-money options here, though. We'll look at the 300 calls. They're down nearly 30% in value. And Apple, again, it's up, but it's only up about 20 cents. And they're down 30% because, and this applies for puts too, when you're trading short-dated, out-the-money options, you need a fast, aggressive move in the right direction. This could be whether it's an analyst upgrade, maybe they have some news, maybe Apple has some new iPhone coming out or something that they leak, or some kind of event. You need a major move, a fast, aggressive move in the right direction to make money on those options. And the same applies for puts. So if you look at the Apple puts, like the 300 puts, they're down about 8%. Okay, Apple's up again a little bit. But if you look at the 280 puts, they're down 35% because Apple is not having a fast, aggressive move lower. And you can eliminate this time decay and the percentage loss, I should say, if you buy options or if you trade options that are further dated. So like February, they expire in 52 days. You'll notice the out the money options are barely getting hit. I mean, 2%, if that. And you'll notice the puts too. They're barely getting hit, less than 2%. You can eliminate this by going out in time, buying higher delta options, so in the money options, when you are trading. And one other thing, because a lot of traders ask me about this, is implied volatility. Implied volatility is, think of it as supply and demand. So here I have Tesla. And the reason why I have Tesla is because, well, it's a madman. It has high implied volatility. The stock's been moving 10 to 20 bucks a day. So market makers will jack up the volatility. They'll jack up the price of the options. Now, some stocks like Tesla, Roku, Netflix, Nvidia, they usually have year-round high implied volatility. But other names like Apple, Microsoft, Intel, they're not going to have high implied volatility year-round, especially if they're going up, unless it's earnings. Volatility normally cools off as the stock goes up and then will dramatically go up if a stock crashes or goes down quickly in value. And the reason why is, think of it as you have a red Corvette sports car. Your insurance is probably going to be more expensive than if you had a Honda Accord because you're more at a risk for speeding, for wrecks, whatever it may be. They're going to jack up the premium there. That's how trading is too. The market makers will elevate the option prices. There's more demand for them in a stock with high implied volatility because it's reckless. Whether a safe stock, volatility, they'll decrease it, and those options become cheaper and cheaper in value. I hope this helps. Options made simple. Let me know in the comments below, and have a fantastic New Year's, everyone.